Did you know that 90% of startups fail within the first 5 years? That's right, almost all new businesses struggle to survive. But here's the shocking part: you don't have to start a business from scratch to create wealth. In fact, you could skip the risky startup phase and jump straight into a business that's already proven and profitable. Every year, thousands of businesses are sold, many of them for a fraction of their true value. In 2023, over 200,000 small businesses in the US changed hands. Most of these were not sold to experienced investors but to first-time buyers, people just like you. Imagine acquiring a thriving business and growing it into something even bigger with minimal risk. In this video, I'm going to show you exactly how to buy a business, scale it, and turn it into a massive source of income. You'll learn why business acquisition can be easier than starting from scratch, how to find undervalued businesses, and most importantly, how to negotiate deals that could make you millions. Stay tuned because by the end of this video, you'll have the roadmap to acquiring a business that could completely change your financial future. Ready to jump in? Let's get started. Chapter 1. Unlocking the secret to business acquisition. Why it's easier than you think. When it comes to creating wealth, many people think they need to start a business from the ground up. But what if I told you that acquiring an existing business is often a smarter move? In fact, buying a business can be easier, faster, and more profitable than starting one from scratch. Research shows that 70% of businesses in the US are owned by baby boomers, and many are looking to retire. This presents a golden opportunity for you. According to a 2020 survey by BizBuySell, 1 in 4 small businesses listed for sale are sold to first-time buyers. That means you don't need years of experience to dive into business acquisition. The key is understanding the acquisition process. Instead of creating a brand new business from scratch, you can leverage an already existing model with an established customer base, products, and systems. The biggest mistake many entrepreneurs make is not realizing that the world is full of businesses waiting for new owners who can breathe new life into them. Here's a simple fact: on average, business acquisitions are less risky than startups. A startup has a 90% failure rate within the first 5 years, while a well-managed acquisition has a far higher chance of succeeding. In fact, the success rate for acquisitions is estimated to be 70%. You don't need millions to start. Many small businesses can be acquired for as little as $100,000, depending on the industry and location. And if you don't have the cash up front, don't worry. The business itself can often finance the deal through seller financing or small business loans. Successful entrepreneurs, like Warren Buffett, have long used acquisitions to build their empires. Buffett's company, Berkshire Hathaway, is known for acquiring businesses that already have a proven track record. You can do the same, focusing on businesses that align with your skills or passions. Ultimately, acquiring a business provides you with a quicker path to wealth. Instead of spending years building a brand, you can take over an already operating business, make improvements, and see financial returns much sooner. Chapter 2. The Hidden Gems. Finding undervalued businesses to buy. One of the most exciting parts of business acquisition is finding the right company. Not every business for sale is a great deal, but there are plenty of hidden gems if you know where to look. The key is searching for businesses that are undervalued or overlooked by others. A recent study by Harvard Business Review revealed that companies acquired for below market prices often have significant growth potential because they haven't been optimized. This means that with the right approach, you can purchase a business at a low cost, then unlock its value by improving its operations or expanding its reach. Start by identifying struggling businesses in stable industries. These businesses often face temporary problems, like poor management, lack of marketing, or inefficient operations, that can be fixed relatively easily. For example, a restaurant with great food but bad location or poor marketing might have tremendous potential if the right changes are made. Use online marketplaces like BizBuySell or businessbroker.net to explore businesses up for sale. These platforms allow you to filter by industry, price, and location, helping you find opportunities that might not be on your radar. You can also look into local business networks or reach out to business brokers who specialize in small business transactions. Another way to spot hidden gems is to look for businesses that have been neglected by their owners. Many entrepreneurs grow tired or overwhelmed and decide to sell without fully realizing the potential of their business. These businesses might not be in perfect condition but can be revitalized with fresh leadership and new ideas. Data from the Small Business Administration shows that small businesses with under $5 million in annual revenue make up the majority of acquisitions in the US. So, instead of aiming for a giant company, focus on smaller businesses that are in need of a new direction. One strategy that can work wonders is to target companies with a strong customer base but poor customer experience. Improving the customer experience often leads to increased loyalty and higher sales. A simple tweak, like revamping a website or improving customer service, can yield huge returns. When it comes to finding undervalued businesses, patience is essential. It might take time to find the right opportunity, but when you do, the payoff can be massive. Chapter 3. Negotiating like a pro. The art of buying a business for pennies on the dollar. Negotiation is an art, and when it comes to business acquisition, it can be the difference between a good deal and a great one. A well-negotiated acquisition can save you thousands, or even millions, while ensuring the business is set up for success under your ownership. Start by doing your homework. The more you know about the business you're acquiring, the better your negotiating position will be. This means understanding the company's financials, customer base, market position, and potential for growth. In fact, a study by the M&A advisory firm Deloitte found that buyers who conduct thorough due diligence are 60% more likely to see positive returns on their investment. One of the most effective negotiating tactics is to approach the seller with empathy. Understand why they're selling and see if you can align your goals with theirs. If they're retiring or dealing with personal issues, you may be able to leverage that emotional connection to negotiate a better deal. Seller financing is another powerful tool in the negotiation process. This is where the seller agrees to finance part of the sale. It's a win-win because the seller gets a higher price for their business, and you don't have to worry about securing full financing up front. Plus, this often results in lower interest rates than traditional bank loans. When negotiating, it's important to remember that the asking price is just a starting point. Most businesses are sold for less than the asking price, especially when the seller is motivated. According to BizBuySell, the average business sells for 60–80% of its original asking price. Be prepared to walk away from a deal if it doesn't make sense. Having the confidence to say no is crucial when buying a business. It shows the seller you're not desperate and that you understand the value of your time and money. Negotiation isn't about winning, it's about finding a fair deal for both parties. Lastly, don't forget to factor in future costs, like working capital needs and any debt the business might have. These elements can affect your final price and overall investment strategy. By mastering negotiation, you can acquire a business for a fraction of what it's worth, giving you a massive advantage when you start scaling it up. If you're finding these strategies helpful, don't forget to hit that subscribe button for more insights into business acquisition and wealth building. Chapter 4. Zero to Hero. Scaling your acquired business with minimal investment. Once you've acquired a business, the next step is to scale it. Many entrepreneurs get stuck thinking scaling requires huge amounts of capital, but that's not always the case. In fact, there are several cost-effective ways to grow your business quickly. One of the easiest ways to scale is by optimizing existing systems. Small improvements to operations can lead to big returns. For example, a simple software upgrade or streamlining workflows can increase productivity without significant investment. According to McKinsey, businesses that optimize their operations see an average of 20–30% improvements in efficiency. Focus on increasing your customer lifetime value, CLV. Instead of just acquiring new customers, find ways to make your existing customers more valuable. Offer loyalty programs, upsell related products, or create subscription models. A 5% increase in customer retention can boost profits by 95%, according to research by Bain & Company. Another effective scaling strategy is improving marketing. But you don't need a big advertising budget to make an impact. Social media platforms like Instagram and TikTok can give small businesses enormous reach with minimal investment. A targeted Facebook ad campaign, for example, can be run for as little as $5 per day. Outsourcing tasks is another powerful tool for scaling. Hiring freelancers or contractors to handle non-core activities can free up your time to focus on growth. A study from Upwork found that 58% of businesses rely on freelance talent to scale faster without increasing overhead costs. Also, don't overlook the power of partnerships. Look for businesses that complement yours and explore ways to collaborate. Whether it's joint promotions or cross-selling products, partnerships can drive growth with minimal cost. Companies like Shopify and Oberlo have built entire businesses through strategic partnerships. Technology can also play a major role in scaling. Tools like CRM systems, inventory management software, and automated email marketing can help you reach new customers, manage existing ones, and reduce costs, all at the same time. The right technology can provide scalability without requiring a lot of upfront investment. Most importantly, focus on building a solid company culture. A motivated, high-performing team will help you scale faster and more efficiently. Research by Gallup shows that highly engaged teams are 21% more productive, which directly impacts your bottom line. Scaling doesn't need to be complicated or expensive. By focusing on smart, low-cost strategies, you can grow your business exponentially without putting your finances at risk. Chapter 5. Mastering the Due Diligence Dance. How to avoid costly mistakes when it comes to business acquisition. Due diligence is everything. This is the process of thoroughly evaluating a business before you buy it. Skipping or rushing through due diligence can lead to costly mistakes down the road. The first step in due diligence is reviewing financials. Always ask for at least 3 years of financial statements. A business with inconsistent or fake records is a red flag. According to BizBuySell, 40% of businesses listed for sale have questionable financials, so it's crucial to dig deep. Look at the company's cash flow, debts, and profitability. A profitable business with steady cash flow is a good sign. But make sure to account for any hidden liabilities, such as unpaid taxes or unreported debts. You don't want to inherit financial trouble when you acquire the business. Another often overlooked area is customer contracts. If the business relies on long-term customer contracts, review them carefully. Are they renewable? Are they in good standing? Poor customer retention can harm the business after the sale, so don't skip this step. Don't forget to investigate the business's competition. A market analysis can reveal a lot about the business's position in the industry. If the business is struggling to keep up with competitors, it could be a sign that it's not well positioned for long-term success. It's also important to review the business's intellectual property, IP. This includes trademarks, patents, and proprietary technology. Ensure that the business owns its IP outright and that there are no legal disputes over ownership. Additionally, review the company's legal standing. Are there any pending lawsuits or unresolved legal issues? According to a report by the National Small Business Association, legal issues are one of the most common reasons small businesses fail. Avoid these headaches by conducting a thorough legal review. Finally, consider the human factor. Look at the business's employees. Are they loyal, experienced, and properly trained? Employee turnover can be costly and disruptive, so it's important to evaluate team dynamics before moving forward. By taking the time to conduct proper due diligence, you'll minimize the risk of making a bad investment. It might take time, but it will save you money and frustration in the long run. If you found this video helpful, make sure to hit the subscribe button and turn on notifications so you don't miss out on more tips to boost your entrepreneurial journey.